We have our 2025 numbers for the gift and estate tax exemption amounts, as well as new federal income tax brackets and long-term capital gains tax brackets. Which, spoilers, everything has gone up, so let's talk numbers and what they mean. Now, I'll spare you too much of a deep dive discussion on each of these topics since we have a lot of numbers to run through, and this video is just going to give you a top-level view of the numbers and where we're heading into 2025. Even then, we have a lot of ground to cover, so feel free to use the timestamps in the description to jump to the sections that interest you. Be sure to share the video with your family or cohort, and let's dive in. Let's begin with gift taxes. As a reminder, when you give something to someone without receiving something of value in return, that's a gift. What's counted as a gift is anything that has value. A cup of coffee, a gift card, cash, a car, a vacation, just to name a few. If you gift something to someone, then that's a transfer of wealth, and the government has an interest in that economic activity and wants to collect a tax from it. However, a gift is not like income. It's not the recipient of the gift who pays the taxes, it's the giver. And that tax can be anywhere between 18 and 40% depending on how much was given. In 2024, we can give up to $18,000 a year to a single person before we needed to tell the IRS and pay a tax on that amount. For 2025, however, we'll be able to give up to $19,000 and not have to pay a tax or even tell the IRS we did it. Now that number is per recipient, not per giver, so I can give $19,000 here and $19,000 there and not pay a tax. Additionally, spouses each are considered as separate givers, so mom and dad can each give $19,000 to daughter, $38,000 total, and not pay a gift tax. Gifting like this is often used in an estate planning context where someone might want to reduce the size of their estate for federal estate tax purposes, which we'll discuss in a moment, or where we want to separate their estate, shelter it somewhere, as through a crummy trust or maybe an irrevocable life insurance trust, and pass that money on to the heirs free from estate taxes and creditor claims. And wouldn't you know it, I've recently done videos on just these sort of trusts, so we'll link to those in the corner as well as in the description below. However, what if you wanted to give more than $19,000 in one calendar year? Well, you can, you just have to tell the IRS that you're doing it through a 709 gift tax return filed with your taxes for the year in which you gave that gift. But to avoid the tax on that amount, you would also apply that gift towards your lifetime gift tax exclusion amount, which is your estate tax exemption amount. Think about it this way. You can give up to the gift tax exclusion amount each year without issue, but if you want to give more, you'll need to tap into your limited pool of your estate tax exemption amount to avoid a tax on that overage. But with that, let's discuss the estate tax so all this can make sense. If the gift tax is how much you can give to someone in a year during your lifetime without paying a tax, then the estate tax limit is how much you can pass on as an inheritance after death without your heirs having to pay a tax. Sometimes affectionately called the death tax, the estate tax is a tax on your total estate that reaches above a certain threshold after you die, but before it's distributed to your heirs and beneficiaries. The exclusion amount is how much your estate can be worth, which means assets like real estate count towards this figure, not just cash on hand, before your estate will have to pay a 40% tax on anything above that limit. For 2024, that limit was $13.61 million. For 2025, that limit's going to be $13.9 million, just a hair shy of $14 million. That means if you're one of the 99.98% of Americans who do not have a $14 million estate, then your estate tax will not be owed if you pass away in 2025. Relating back to the gift tax we just discussed, if you wanted to give more than $19,000 a year to someone, then you can do so by tapping into your estate tax exclusion limit so as not to pay a tax for that year. What you're essentially be doing is drawing from that $13.99 million limit and saying that you're going to be using some of that now to give someone some extra money in 2025. Maybe you bought one of your children a car or are helping with a down payment on their home. We're going to exclude that first $19,000, then draw from your $13.99 million estate pool to exclude the rest from the gift being taxed. Additionally, advanced trusts like irrevocable life insurance trusts allow you to send money out of your estate so that it's not even a part of the calculation for estate taxes. Have it pay for life insurance policy where the proceeds are also excluded from your estate, and the payout will also be sheltered from your creditors. However, I'm sure some of you are thinking, Andrew, that's great and all, but what would be the point? I don't have creditors to worry about and my estate is never going to be worth $14 million. Why do I care about any of this? Well, there are quite a few reasons as to why you should care. Your state may impose its own estate tax and do so at a much lower threshold. These figures are federal and will be changing in 2026, and your creditors aren't set in stone. Life happens and sometimes business dealings go bad or medical debt piles up on you. But let's just quickly talk about those first 2 points since creditor avoidance requires its own spotlight. Firstly, let's talk about state estate tax. Connecticut, Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, New York, Oregon, Rhode Island, Vermont, Washington, and Washington, D.C. each collect a state estate tax, and most of them are at a much lower threshold than what the federal estate tax level is set at. As you can see with the chart on screen, everyone's thresholds are in the millions of dollars, but vary wildly, with Connecticut at the highest as they just set it with the federal rate. And our neighbor, Oregon, having the lowest threshold at only $1 million, which is relatively easily obtainable with a house and a nice retirement account, especially in dual income households. Additionally, every state's estate tax is in the double digits. Connecticut and Maine are at the lowest at only 12%, while Hawaii and Washington are at the highest at 20%. And in Illinois and New York, they'll tax the entirety of the estate, not just the overage, if the overall value reaches above 105% of the exemption limit in New York, or even if you're only $1 over the exemption limit in Illinois. As you can see, lowering your estate's value can be very imperative if you live in a state that also collects their own estate tax. However, what about those federal numbers? Are they fixed, and why do they move? During the Obama administration, the estate tax exemption level was greatly increased and tied to inflation so that it would continue to grow over time. During Trump's administration, the 2017 Tax Cuts and Jobs Act, the TCJA, took that Obama-era level and doubled it, keeping it indexed to inflation, but slapped an expiration date on it. The expiration date is the close of 2025. That means if Congress doesn't do anything to extend this current level, it will be cut in half in 2026, which would put it somewhere around $7 million. Still high, but not as high as what we've been used to for at least 8 years. This brings us to capital gains taxes, the taxes you pay on the sale of an asset, essentially your profit. There are 2 types of capital gains taxes, short-term and long-term capital gains. If you own the asset in question for less than a year before selling it, then the tax you pay on that gain is equal to whatever your ordinary income tax rate is, which is changing, but we'll cover that next. Long-term capital gains, however, refers to when you sell an asset you own for a year or longer. In that case, your tax rate is going to be either 0, 15, or 20%, depending on your taxable income and whether you are a single filer or married filing jointly. As you can see from the charts on screen, most folks will pay either 0 or 15% in capital gains taxes. Keep in mind that this triggers whenever you sell something like real estate or securities in an investment or a brokerage account. Going further, there are also credits and benefits you get from selling real estate, specifically your primary residence, and you can benefit from a reduction in the amount subject to capital gains taxes in the first place, but those are subject for their own videos and ones I've covered in many videos before. On that note, however, let's move on to income tax brackets. The federal income tax brackets for the 2025 tax year for returns filed in 2026 have been increased across the board. The top rate of 37% applies to individuals with taxable income above $326,350 and married couples filing jointly earning $751,600 or more. Income tax brackets are also something that will shift back to lower levels if the 2017 TCJA expires at the close of 2025. If those provisions do expire, then the tax brackets will revert to 2017 levels. Again, we have a lot of time before we get there, so I'll keep you updated as we learn more. The standard deduction on your taxes will also be increasing for 2025, raising to $30,000 for married couples filing jointly, up from $29,200 in 2024. Single filers will be able to claim $15,000, which is an increase from $14,600. Again, another instance of something in the tax code that will change if the 2017 TCJA is allowed to expire for 2026's taxes. Finally, let's finish off with the tax credit, the child tax credit. The refundable portion of the child tax credit, which is a tax break parents can take for qualifying children, will not be changing in 2025. For 2024, the child tax credit is $1,700. that represents how much families can claim even with zero tax balance on their tax returns. That figure will remain unchanged for 2025 and will drop down to only $1,000 if the TCJA is allowed to expire. However, both parties have indicated a desire to increase this credit, and so I wouldn't be surprised if this increases in the future, no matter which party is in the majority of the House as well as the White House. Obviously, from an estate planning perspective, the numbers we're primarily concerned with are estate and gift taxes. Remember, everything I discussed was at the federal level. Each state is free to make their own state rules as to how much to collect on their own taxes from their residents. Where you see variation is income and estate taxes. While the federal level to be excluded from an estate tax is high, the states that do collect their own estate tax are at much lower levels, with the exception of Connecticut just copying what the feds do. There are ways to avoid estate taxes by reducing your estate's value, but that is planning you will need to do while you are, of course, alive and able to manage your affairs with a great attorney at your back, of course. And finally, keep in mind that we're going to potentially see some massive change-ups in the tax code for 2026 and beyond, depending upon the outcome of this election, which, as a reminder, has not happened for me as of the time of filming, and whether the two houses of Congress and the White House can get along. But this is where I pass it off to you. Did any of the numbers we talked about today surprise you? Did you realize you need to do some special planning on your estate or that your parents need to do the same? Let me know in the comments down below, along with any other questions or topics you want me to cover. As always, don't forget to like, share, and subscribe to learn how to protect your estate and create generational wealth. I'm attorney Andrew Bethel, and I'll see you at our next meeting.